While taxes may be the last thing you want to think about this holiday season, if you don't watch this video and take action before December 31st, it could be the difference between paying a substantial amount of taxes next year on your crypto earnings and paying nothing at all. Let's dive in. Last summer, the IRS and the Department of Treasury issued final broker regulations. These regulations require crypto exchanges to report tax forms to the IRS and to taxpayers, starting with the 2025 tax year. What this means is that the IRS is going to start receiving information on your cost basis, sales price, and your gains and losses on your crypto trades. There really is no more hiding your crypto activity. But what's important, and the reason that we're making this video, is that it provides a huge opportunity to save on your taxes, but you have to pay attention and you have to take action before the new year. That's right, if you wait too long, this opportunity could pass. And that's because under these new regulations, the exchanges are going to be reporting to the IRS, but also there's an opportunity to fill in or allocate your cost basis from all of the tokens and crypto assets that you've purchased in years before. Because as you start to sell in 2025 and in the future, these crypto exchanges won't have the information from all of your purchases before. And so the IRS has provided what's called a safe harbor, an opportunity for crypto investors who have crypto that they've purchased in these earlier years to allocate or determine how they want their cost basis ordered as they start to sell in the future. And this means that you could determine, for instance, if you want to sell your oldest crypto first, or if you want to sell your highest cost basis first. And by deciding that, you can greatly impact your gains. Because if you sell your highest cost basis first, you may then have very little or no gains, or even losses, depending on the price of crypto as you sell it. But this determination and allocation has to be done and in writing before December 31st. And so there are a few key steps that you have to do in order to comply. Number one, make a list of your exchanges and wallets. And this is going to be crucial because it'll help us with our next steps. Identify any of the wallets that you currently hold that have digital assets in them. This might be hosted or unhosted wallets, or even crypto exchanges. Next, we're going to go to each of these exchanges or wallets and take a screenshot or snapshot or somehow save an image of what you are holding on each of those wallets. What I mean by that is each of the digital assets, be it Ethereum, Bitcoin, and so forth, what is the volume that you're holding and what is the current date? An easy way to add the date to a screenshot is through opentimestamps.org. You can add an image and upload it there, and they can add a timestamp. Now, take all of these images and save it somewhere that you can keep it for the future. Now you've got an inventory, and you also have a list of all of the different wallets and exchanges with their screenshots. The next step is to fill out a safe harbor statement that complies with the revenue procedures issued by the IRS. As a free holiday gift to all of you, we have created a template, a draft of this safe harbor allocation, and it allows you to check a couple boxes, fill in some blanks, and comply with the rules. I've got a link below that you can click, fill it in, and save it to your records. Once you've saved it, make sure you also provide a copy to your accountant, because this form will be crucial not only in future years as you start to sell, because it determines the method that you will sell, but it will also be required in case of an audit to support the allocation method that you've determined. By complying with the safe harbor requirements, you've set yourself up to be successful for future years by allocating your cost basis in an effective way. But if you don't take these steps, you might be left using a first in, first out allocation method, which isn't always a bad thing. But if you're in an appreciating market and you've bought crypto at a lower price, then a first in, first out will generally mean that you'll have larger capital gains in the more immediate years, but you can also have a greater likelihood of having long-term capital gains, which is at a lower tax bracket. So if you're watching this video, you definitely want to take action before the end of the year. Now, which method makes the most sense for you? You should contact a tax professional and discuss your holdings and see what makes sense based on your plans to sell for future years. But linked below, we have a copy of a safe harbor statement that you can use and fill out before the end of the year. Over the last few years, the IRS has been weaponized against crypto investors, and these new regulations are just another example, being issued in the middle of the summer and being effective before the end of the year. This only gave practitioners a few months to understand the rules and even come up with solutions such as a safe harbor statement. And so share this video with your friends. Most people have no clue what these requirements are. Thanks for watching, and until next time.